one that I love is, if you don't learn to make money while you sleep, you'll have to work until you die. Now, unfortunately, a lot of people who want to do real estate on the side, they've seen HGTV or they've seen the house flipping shows, and they realize when they get into it, it's much, much harder and often, not always, often less profitable than it looked like.
All right, welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, founder and CEO of Appleman Capital. Today we're joined with Paul Moore. Paul is the founder of Wellings Capital. After selling a staffing firm, Paul invested in real estate, founded multiple companies, and appeared on HGTV, a regular contributor to BiggerPockets, and co-host of How to Lose Money. He's authored books on multifamily housing and self-storage investing. Paul, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Yeah, it's great to be here, Josh. You mentioned the How to Lose Money podcast. When I sold my company to a public firm in 97, I was 33 and I should have known better, but I apparently didn't. I thought that I was a full-time investor at that point. And I think looking back on my track record, I was more of a full-time speculator. And I think investing is when your principal is generally protected and you've got a chance to make a return. And speculating is when your principal is not safe at all and you've got a chance to make a return. And there's a big difference. And so I've sort of on a mission now to help educate our investors about the difference and about, how they can even accidentally speculate when they think they're investing like I did.
Let's get into that. So you sold your company, and tell us what happened. What was the learning lessons there?
I had an MBA, an engineering degree, and I should have known, the difference. I should have known, about speculating, swinging for the fence, all that. But I just thought that every investment, I really think I was a 33-year-old high energy entrepreneur who became bored pretty quickly. And so I think I wanted to get the same excitement and thrill out of investing that I got out of being an entrepreneur. So I call that being an entrepreneurial investor. And I've since then have completely changed my strategy over the last couple decades to be more of a boring investor. And I really like it that way. I can have fun with hobbies, family, other stuff I'm doing. I don't want my investments to be exciting. The first guy who won the Nobel Prize in economics from the US said investing should be boring. Investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas.
That's pretty good. So I take it that you sold your company, you made a pretty good exit, and then you might have made some other investments that weren't so promising.
Yeah, absolutely. Yeah, I mean, I invested with a guy who was making 2 to 3% a month for his investors in some kind of hard to explain foreign currency exchange. And I think he's on year 22 or 23 now of his 158-year sentence.
Oh, wow.
And that's what amazes me about Buffett and Munger. God rest Munger's soul. They were Munger is the most brilliant mind in the world in investing, according to Bill Gates, Warren Buffett, and others. And Munger's chief specialty was not doing stupid things. He was like the master of stupidity reduction. And he said, I don't have to use all my brains, all my smarts, all my wisdom, all my 500 books a year I read. I just have to avoid being stupid and avoiding repeatable mistakes. And that's why we called our podcast How to Lose Money, because we interviewed 238 successful entrepreneurs and investors over the 4 years we ran the show. And we talked to them about, how can we make sure we don't do the stupid thing you did before?
Yeah. I could see where that podcast can be huge value just by getting the firsthand point of view from people who have learned those lessons first. And that's usually no matter how many times it's told you, there's nothing like learning it firsthand, learning those valuable lessons, and then hopefully passing that knowledge on.
Yeah.
So you got into real estate, and like a lot of other people, you liked real estate. Tell us how you sold your company, you invested into other people's companies. You might have, it sounds like you lost some money, but you've got some lessons learned, and then you got into real estate. So what happens then?
Yeah, so I spent about I did one commercial investment in 1999, and then I jumped into residential, flipped 60 or 70 houses, flipped about 30 waterfront lots at a resort called Smith Mountain Lake in Virginia. And I really wanted to get into commercial, wasn't sure the entry point. And then in the Bakken oil rush in, let's see, 2010, 11, 12, we invested in oil and gas there, which was another speculation, to be honest. And we realized there was a massive housing shortage. So we quickly bought 75 acres, built two multifamily quasi hotels there. And we housed oil workers, practically printed money, and sold while the oil price was around 90 or $100 a barrel. Now, if we'd have held another year, oil prices had dropped to $30 a barrel. So ultimately, that was an example of what I was saying at the beginning of your show. Sometimes even things that look like investments can be speculative if they have a single point of failure. And the single point of failure for that investment was oil prices. And so honestly, I mean, there's no way I would ever invest in that again, 15 years later.
It sounds like you all got out and just in the right time. Was there a reason why? Was there kind of like writing on the wall, and you made it a smart move to get out, or was it just total luck at the drop
No,
there?
Josh, it was so we could do another speculation. We actually
Okay.
had a Hyatt, we had a Hyatt hotel, Hyatt House Hotel under construction. And this was going to be my business partner's so-called retirement. He took money from several other companies he sold, and he funded a lot of this Hyatt House Hotel. And it was also based on oil prices. It was the nicest hotel, far as I know, still is the nicest hotel in North Dakota over there in Minot. And when oil prices crashed and a number of other things went wrong, that hotel did not end well for him. But by then, I was already a couple of years down the road as a multifamily syndicator.
Wow, that's incredible. So you've gotten the oil, gas, and now all of a sudden you've amassed $135 million in equity under management. So what makes up the CRE funds that you all manage?
Yeah, so I was jumped into multifamily syndication. I wrote a book with a humble title called The Perfect Investment about multifamily. And then I got really nervous, Josh. Toward the middle and the end of the decade, I saw multifamily syndicators who were taking incredible risks, using floating rate debt and over leveraging and overpaying. And especially in the Texas area, where there's a lot of folks who come out of multifamily training programs, honestly, some of them were overpaying for assets. And we just got really nervous about that. So we pulled back and created, we thought, what are the two things we want as investors? We want deep specialization in one asset class, one asset type specifically, and then also a broad diversification in the way we invest. And we thought, well, it seems to me that creating a fund would be able to accomplish both. And we couldn't think of another way to do it. So we're on our sixth fund now. And our six funds, the current fund at least that's open, and that's the only one open right now, invest in self-storage, mobile home parks, RV parks, multifamily, light industrial, and open air shopping centers. And we invest regular common equity and preferred equity in this fund.
Nice. I like how you put the deep knowledge, because when you go in a mile deep instead of a mile wide, you have a very specialized trait, and you can keep your finger on the pulse
Yeah,
and kind of see on the forefront of where things are coming down. And your diversification through your premier operators out there who know their trades very well and know how to manage the properties and the operations professionally and effectively. That's very
right.
cool. Um, what can your investors? I know one thing. Reading your bio, you bring up investing like Warren Buffett. Can you elaborate on that for us so that the listeners know your principles behind the emphasis?
Yeah, so Buffett's funny. I have a book I'm working on with 24 of his quotes and principles and trying to apply them to real estate investors. There's so many, I'm not sure where to start. One that I love is if you don't learn to make money while you sleep, you'll have to work until you die. Now, unfortunately, a lot of people who want to do real estate on the side, they've seen HGTV or they've seen the house flipping shows, and they realize when they get into it, it's much, much harder and often, not always, often less profitable than it looked on TV. And so they're not really, they're basically a lot of them, a lot of our investors are doctors and IT professionals and dentists, and they're basically buying a job on the side. Uh, I heard one of them talking about, dealing with a 2 a.m. call for a toilet, and others, dealing with fixing plumbing on their weekends, looking for new houses to flip on their, vacation evenings, lunch hours, screening tenants, dealing with all this stuff. And even if they have a property manager, they say, honestly, I just would rather be passive. And so I think that's what Buffett's talking about, making money while you sleep is really being a truly passive investor. Um, he talks about, betting on the horse versus the jockey. And, we really believe that, as far as our fund, we reviewed 515 potential investment opportunities last year. We only invested in 11, and we knew about 7 or 8 of those operators very well already. So we only invested in like 4 or 5 new opportunities last year after all that, due diligence. And, Buffett says the most successful investors say no a lot. The very most successful say no almost all the time. Um, I talked about earlier the complicated foreign trading strategy. Buffett and Munger say that they have 3 boxes in their office. Um, yes, no, and too hard. And the vast majority of the deals go in the too hard box. They say if they can't explain them very, very easily and understand and follow the money, they would definitely be a no. So those are some of the things I've learned from Buffett. And like I said earlier about speculation, his most famous saying, perhaps, is don't rule number 1, don't lose money. Rule number 2, see the first rule. Not losing money is way more important than making money. And the proof's in the pudding. Josh, if Berkshire Hathaway lost 99.4% of its value, it would still beat the S&P 500 since 1965.
That's incredible. That's wild to think about. What you'd mentioned due diligence. What kind of due diligence are you all putting these potential investments through to undergo the next
Yeah.
phase?
Yeah, we do most of our due diligence on the operator, and we're really trying to get to know them, see how they treat people, see how they even talk about their investors, talk about their spouse. Um, we do deep, background checks, criminal checks. We're checking their debt very carefully. We're even checking their lenders. We did a background check on a lender once and found out that their chief guy was in prison. And so we didn't really like that. That was interesting deal. That was a mobile home park deal where we were going to come in with some of the equity, but there was a lender for the mobile homes themselves that was, a little different. We check, like I said, we check the debt terms and covenants very carefully. We're checking their track record. We go to meet with their team. We drop in announced and sometimes unannounced on their properties. We do a deep dive in Google called Death by Google. Anybody can do that. We actually just went through CIA training. These were former CIA um, uh, detectives, I guess you could call them, interrogators, and they trained our team in how to look for lies, how to spot lies when you're interviewing a potential syndicator. We do all kinds of stuff like that.
But it's for good cause and good reason. You've got people that are investing into you with good faith that you all are vetting and verifying that the people are who they say they are. They can do what they
Right.
say they can do.
Right.
And I think we like your first experience. We assume that other people do things the way that we do them as good. And there's a lot of things that we might find out that what we think is normal, other people think is above and beyond.
Right.
And that's just our standard to doing things. So I think that assumption is an entrepreneur spirit is just because you're true gritting it a lot of getting out there and building a business, but you want
Yeah.
to build it to first class rate. So
Right.
the way you all take things through due diligence is incredible. What has been some learning lessons that you have found along the ways of uncovering things, and then how has I guess your experience how's that proven to be effective? Because that's y'all are a massive firm, so you've seen some things out there.
Josh, one thing we've learned is, and it's really hard to explain this, but I really think we were designed and created with clearly a lot of ability. Our brain does, what is it? 3 or 4 quadrillion calculations a second. I don't know how that's possible, but I think we can observe a lot of things we can't explain. So if I'm talking to you and you're not telling me the truth, I shouldn't use you as an example. If I'm talking to a syndicator and they're lying, I might not know that, but I think that deep in my heart, there's like 3,000 body signals and tonal signals that we can pick up on subliminally. And I think that if I have this thing called a bad gut feel, that's probably there for a reason. And I need to pay attention to my gut. And sometimes when I've ignored it, I couldn't quantify why, but I just had a bad feeling, but I went ahead anyway. And those were some of the worst investments. I'm talking 20 years ago when I think about these. I'm thinking of a few, and like the one I told you about, the guy in prison. I just had a funny gut feel, but I went ahead anyway because it looked good on paper. And to a 35-year-old, it really made a lot of sense. I think to a 60-year-old now, I think I would have seen through that. I hope. But that's been a big one, that gut feel thing. Another thing that happened to us recently, we did months of due diligence, multiple flights, just hours and hours and hours on the phone and Zoom with these people. And at closing, after we wired the money, they changed a key term in our agreement with them. And that was it. We didn't negotiate anymore. We just pulled the plug, got our money back from the title company and walked away. I mean, you just don't do that. And it's just, those are some of the things we've learned. There's so many more. It's hard to even tell you where to start.
Sounds like that could be the next book, maybe.
Yeah,
And,
that's a great idea.
no doubt. But and that's part of it. When they're willing to change terms, change a key component of anything on the onset, who knows what's going to happen there after you all close? Because that's it's just spiteful. But those are learning lessons that you've acquired through the years, and ultimately keep other investors safe and shielded from those nefarious activities just by going at it alone.
Right.
It's just the unfortunate hard truth, and you're there to hedge them against that.
Right.
Let's get into to mobile home parks and self storage, because I know that your funds are heavy on these asset classes. You like them, you enjoy them, you like the operations.
Yeah.
Tell us a little bit what you look for on these.
So mobile home parks are the only asset type we know that have a decreasing or pretty much stable supply and a significantly increasing demand every year. They've been stable in good and bad economies. The biggest risk with mobile home parks, I think, is the potential. Some of the blue states have had real problems with, they've really jumped in and done a lot of rent control and eviction moratoriums and stuff like that. But mobile home parks, you can actually create a home for somebody. When I think of my childhood home just north of you, I have fond memories of that. Well, these are someone's home. And so we want to partner with operators who make that metal box that spits out money, as other people call them. We want to create a neighborhood and a home and do something nice for these tenants, but also charge them fair market rates. And so just, mobile home parks are a great investment opportunity. Sam Zell tapped into this in the 1960s when people looked down their nose at mobile home parks. He was acquiring mobile home parks. He's got last I checked, before he passed away, he had 158,000 mobile home park pads
Wow.
nationwide, and became a billionaire and helped a lot of other people get very wealthy from his strategy. We also like self-storage. Self-storage blew up in a good way in the last 5 or 10 years. I wrote a book called Storing Up Profits, and that's available at BiggerPockets Publishing. And we talk about the fact that of the 50 some thousand self-storage facilities in the U.S., 75% are owned by small operators, and 2/3 of those are single asset operators. And that's an opportunity to when you buy from a mom and pop, sometimes you can pay them a fair price, and there's all kinds of intrinsic value. Buffett and Munger say that the key to their investing is buying durable assets with great operating teams, way under value. He said value is what you get, price is what you pay. And so a lot of these assets, they can be improved by adding, outdoor storage, or adding additional storage units, or selling locks, boxes, tape, and scissors. Um, maybe putting up billboard space by the road, doing a propane filling station, adding an ATM, even a cell tower in the back. All kinds of additions that can make the value add on a self storage is very, very powerful. And so we're looking to invest in value add self storage facilities, typically acquired from mom and pop sellers.
Yeah, especially you can automate self-storage in so many different ways,
Yeah.
and the minimum staff requirement, it definitely makes it makes it the shiny object for sure, and for good reason. But
Right.
it's a billboard on the back or a cell phone on the back. I mean, there's really not really a better way of increasing the value of the property when you have zero cost out there.
Right.
That's good. I like it. And then RV parks, I mean, it's your customer service, in my opinion, as an operator is number one. The better you treat your customers, the maintenance request, rapid response, your customers are going to stay around for the renewals every single year. And that's just where the gift keeps on giving. Give them value, and they'll stay around as long as you want them to.
Yeah.
So
Right.
tell us what the future looks like. Where does Paul want to take his investing journey?
Yeah, so I'm a big believer in the traction, Geno Wickman traction,
Oh
EOS
yeah.
model. I floundered around a lot over the last 30 years, and a lot of the businesses I started didn't really get that far because I didn't understand the difference between being a visionary, which I am, and having an integrator. And so our company has an integrator. He actually started out his senior year of college almost 10 years ago, and now he's a partner in the company. And I recommend that anybody who's a visionary get an integrator, or if you're an integrator, get with a visionary. And because of that, I think that we're really poised. I think we've got the key hires done. We've got a team of about 8 or 9 people, and we love the model, and we really believe we're going to be doing a lot of preferred equity rather than just common, as long as interest rates are high. And then in regard to what we're going to be investing in the future, the 6 asset types I mentioned are probably where we're going to stick for now. But we'll be continuing to look. People have asked why we haven't looked at senior living. We might look at that someday. I don't think we'll get into mall exotic stuff like mall to storage conversion, or mall to housing, or office to storage, or office to housing. That's just too much risk for an asset type for us that we can make a pretty nice return on without taking those types of risks. However, my hat's off to the people who do those things.
Yeah, I didn't really. If you're on EOS and you've got your VTO completed for the next 5 years and possibly 10 years of where you're heading, taking the company, and
Yeah.
if you're a visionary, you're also, in a lot of cases, you're forced to be the integrator, and then you're capping yourself, and then a lot of things get undone that are could be very, very good ideas and propel you greatly into the future. But EOS is great to operate off of. Gives you really just a total structure of your company.
Right.
Very cool. If somebody wants to reach out to you, get a hold of you, learn more about yourself, possibly invest alongside of you, how can they reach out?
They can reach us at Wellings, Wellings, wellingscapital.com. And the best way to do that would be to go to wellingscapital.com/resources, where we have special reports on RV parks, self-storage, mobile home parks, general commercial real estate investing, access to my books, etc.
Awesome. All right, Paul. Definitely appreciate you coming on the phone today. I look forward to following you, and we'll certainly talk soon.
All right, Josh, thanks so much.
Thanks, Paul. Bye.